The shadow system does not appear on most balance sheets. It does not accept deposits in the traditional sense. It does not operate through local branches or advertised savings accounts. Yet it creates credit and provides liquidity. It supports the same financial architecture that commercial banks depend upon. It operates beside the visible system. And when it strains, the visible system strains with it. In this chapter, we will examine how the shadow banking system functions, why it became essential to modern finance, and how its slow destabilization signals structural limits within the broader monetary order. By the end, the phrase "they won't admit it" will no longer imply secrecy, but structural necessity. The shadow system emerged not as conspiracy, but as adaptation. Traditional banks are constrained by capital requirements, reserve ratios, and regulatory oversight. As global demand for credit expanded, financial institutions developed parallel mechanisms to generate liquidity outside those constraints. Money market funds, repurchase agreements, asset-backed securities, structured investment vehicles, securities lending chains, collateralized debt obligations. These instruments operate without the same balance sheet classification as retail banks. Yet they perform similar functions. They transform short-term funding into long-term assets. They multiply credit beyond deposit bases. They create liquidity that appears stable until it is not. The contradiction is quiet. The shadow system exists to reduce systemic risk through diversification and market-based discipline. Yet it also concentrates risk in less transparent channels. Unlike traditional banks, shadow institutions rely heavily on wholesale funding. They borrow short-term in markets, such as the repo market, pledging collateral, often government bonds or high-grade securities, in exchange for cash. This funding must be rolled over continuously. Confidence is therefore not abstract, it is daily. If counterparties refuse to roll repo agreements, liquidity evaporates quickly. This evaporation does not announce itself through branch closures. It appears in funding spreads, haircuts on collateral, and sudden reluctance in interbank markets. Few outside financial circles observe these metrics closely. By the time they become widely discussed, strain has already matured. The 2008 financial crisis is often remembered as a housing collapse. In reality, it was a shadow banking crisis. When mortgage-backed securities lost perceived safety, repo markets tightened. Collateral was questioned. Funding dried up. Institutions that appeared solvent faced liquidity shortages. Bear Stearns did not collapse because its buildings disappeared. It collapsed because short-term funding withdrew. Lehman Brothers followed a similar path. The shadow system had grown larger than the regulated banking system. When it faltered, the entire architecture trembled. Governments intervened massively, extending guarantees beyond traditional banks to money market funds and other non-bank entities. The intervention preserved stability. It also formalized dependence. Since then, regulation has increased transparency in some areas. Yet shadow activities persist. They evolve. Exchange-traded funds provide liquidity transformation. Private credit funds extend loans outside bank balance sheets. Derivatives clear through centralized counterparties. Each layer adds efficiency. Each layer adds complexity. Complexity distributes risk widely. It also obscures concentration. Obscurity delays recognition. Recognition is rarely immediate. The phrase "is breaking" does not refer to collapse in a dramatic sense. It refers to cumulative stress that narrows flexibility. In recent years, episodes of sudden funding strain have surfaced periodically. Repo rates spike unexpectedly. Liquidity injections become necessary. Central banks step in preemptively. These interventions are framed as technical adjustments. Technically, they are. Structurally, they reveal fragility. If a system requires frequent liquidity support to maintain smooth functioning, its internal resilience has shifted. Resilience once derived from capital buffers and organic funding. Now it often derives from coordinated policy. Policy support is powerful. It is not infinite. The shadow system's size has expanded relative to global GDP. Private credit markets alone have grown dramatically, providing loans to corporations that banks may not hold directly. This expansion allows credit to flow even when banks tighten. It also creates parallel leverage. Parallel leverage complicates oversight. When stress emerges, authorities must decide whether to extend backstops beyond traditional boundaries. Extending backstops increases moral hazard. Withholding them risks contagion. This dilemma remains unresolved. In monetary history, systems often break not at their center, but at their edges. In the 19th century, panics frequently began in speculative lending markets rather than central banks. In 1907, a failed attempt to corner copper stocks triggered a run on trust companies. These institutions were outside the national banking system. Trust companies performed bank-like functions with fewer constraints. When confidence eroded, they lacked sufficient backstops. The crisis prompted the creation of the Federal Reserve. Shadow banking today occupies a similar perimeter. It performs bank-like functions without identical guarantees. If its funding mechanisms falter, stress migrates inward. The interconnectedness of modern finance ensures collateral chains link institutions globally. A treasury bond pledged in a repo may support multiple transactions across markets. Rehypothecation multiplies claims on the same asset. Under normal liquidity, this enhances efficiency. Under stress, it magnifies demand for safe collateral. Collateral scarcity raises funding costs. Higher funding costs compress margins. Compressed margins force asset sales. Asset sales depress prices. Depressed prices weaken collateral values further. The loop accelerates quietly. It is often interrupted by central bank liquidity provision. Liquidity provision stabilizes funding. It does not eliminate leverage. Leverage remains embedded. Debt levels globally continue to exceed historical norms. Sovereign debt supports repo markets as primary collateral. If sovereign risk perceptions change, collateral valuations shift. Even minor shifts influence funding stability. Reserve currency dominance intersects here. The US dollar underpins much of the shadow system. Repo markets, derivatives clearing, global trade financing all rely heavily on dollar liquidity. If dollar funding tightens globally, shadow institutions feel it immediately. Dollar shortages have occurred repeatedly. In the past decade, requiring central bank swap lines to stabilize markets. Swap lines are extraordinary tools. Their repeated use signals structural dependency. Dependency narrows autonomy. Autonomy once characterized market-based finance. Today, shadow institutions operate within an implicit policy framework. Policy frameworks provide reassurance. They also reveal that organic equilibrium has shifted. The public rarely hears about repo rate spikes or collateral haircuts. These are considered technical matters, yet they determine whether markets function smoothly. When technical measures require persistent adjustment, structural tension accumulates. It is rarely acknowledged openly because acknowledgement itself can unsettle confidence. Confidence sustains shadow finance. Without confidence, wholesale funding contracts. Wholesale contraction cascades rapidly. Unlike retail deposit runs, which unfold visibly, wholesale runs occur electronically and swiftly. They may be contained before reaching public awareness. Containment masks fragility. Masking does not remove it. Private credit markets illustrate another dimension. Corporations increasingly borrow from private funds rather than banks. These loans are often less liquid and less transparent. During growth phases, private credit appears stable. In downturns, redemption pressures may force asset sales. Asset sales reveal valuation discrepancies. Discrepancies unsettle investors. Investors reassess risk. Reassessment reduces inflows. Reduced inflows constrain lending. Constraint tightens economic activity. Economic slowdown feeds back into default rates. Default rates stress private credit portfolios. The cycle deepens quietly. Shadow systems often appear robust until liquidity preference shifts. Liquidity preference can change for many reasons. Rate adjustments, geopolitical uncertainty, currency volatility. The cause is less important than the effect. When liquidity preference rises, participants prefer cash or high-quality collateral over leveraged exposure. Shadow structures depend on continuous rolling of short-term funding. If that rolling slows, strain emerges. It may be resolved through central bank intervention. Intervention reinforces the pattern of dependency. Dependency redefines the system's character. In earlier eras, banking crises often led to institutional reform. The Panic of 1907 led to the Federal Reserve. The Great Depression led to deposit insurance. The 2008 crisis led to expanded regulation and oversight of derivatives. Each reform addressed visible failure. Shadow systems adapt to regulation. Adaptation shifts activity elsewhere. Risk does not disappear. It migrates. Migration obscures. Obscurity delays response. When observers state that the shadow system is breaking, they refer to episodes of funding stress, liquidity injections, or sudden volatility in placid markets. Such episodes do not necessarily signal imminent collapse. They signal narrowing margins. Margins determine resilience. If resilience depends increasingly on intervention, structural transformation is underway. This transformation may not be publicly acknowledged. Acknowledgement can destabilize confidence. Instead, language remains technical: liquidity management, market functioning, stability operations. Each phrase conveys calm. Calm can coexist with fragility. Fragility intensifies gradually. Shadow banking expanded because traditional banks could not meet global credit demand under regulatory constraints. Its growth reflected economic dynamism. It also embedded systemic risk outside traditional oversight. Attempts to integrate shadow institutions often lag innovation. Innovation accelerates. Oversight follows. This lag creates periods of opacity. Opacity fosters complacency. Complacency underwrites leverage. Leverage amplifies fragility. Fragility invites shock. Shock invites intervention. Intervention stabilizes. Stability encourages further leverage. The cycle persists. The breaking point in such systems is rarely singular. It is cumulative, manifesting as increasing frequency of required interventions, as shrinking tolerance for volatility and rising sensitivity to minor disruptions. If repo markets require routine backstopping, if private credit valuations remain elevated despite weakening fundamentals, if collateral chains lengthen further, the shadow system's internal coherence shifts. Coherence once derived from dispersed risk and market discipline. Now it derives from managed liquidity. Managed liquidity can endure for long periods. It redefines the system quietly. The public may not perceive the change. They see stable asset prices. They see functioning payment systems. They do not see the dependency beneath. Historical precedent suggests that shadow systems break not through announcement, but through absorption into formal structures. After 2008, many shadow functions received implicit guarantees. The boundary between shadow and traditional blurred. Blurring increases systemic reach. Reach complicates reform. If the shadow system strains persistently, further integration with central policy frameworks may follow. Integration formalizes dependency. Dependency narrows flexibility. Flexibility once allowed markets to self-correct. Now correction often requires coordination. Coordination signals maturity. It also signals fragility. Money has evolved through layers of abstraction over centuries, from metallic coin to paper note. From paper note to digital ledger, from bank deposit to derivative exposure. Each layer increases efficiency. Each layer distances value from physical anchor. Shadow banking represents a high level of abstraction. Abstraction thrives in confidence. When confidence shifts, abstraction is tested first. The breaking of a shadow system may not resemble visible collapse. It may resemble progressive normalization of intervention, progressive acceptance of reduced spontaneity, gradual recognition that liquidity is conditional. Conditional liquidity alters behavior. Behavior shapes markets. Markets define monetary order. If historians examine this era, they may not identify a single moment when the shadow system broke. They may note a series of liquidity events, repo spikes, swap line activations, private credit stress, collateral shortages. Individually technical, collectively structural. They may observe how each event prompted measured response, how responses accumulated, how autonomy narrowed, and how, over time, the shadows ceased to be peripheral and became foundational. Foundations define stability. If the foundation requires continuous support, stability becomes administered. Administered stability differs from organic resilience. It functions, it persists, it transforms expectations. Money fails slowly. Shadow systems break gradually. And when the break becomes undeniable, the architecture has already shifted. Not through declaration, through adaptation. That pattern has repeated across monetary history. It remains visible to those who examine margins rather than headlines. The system does not announce its fractures. It manages them. Until management becomes the defining feature. And by then, the transformation is complete.